To qualify to deduct a loss, you must have materially participated in the business, which means you worked in the business regularly or were the main worker in your business. Now, if you did not materially participate in the business, then the loss is considered a passive loss and other rules apply. Also, to qualify to deduct the loss, you must be the only owner or investor in your business. This means that you must be at risk for all of the investment in the business. If only part of your investment is at risk, you may still be able to deduct a portion of the loss. Line 32 on Schedule C asks you to check the box for either all investment is at risk or some of the investment is at risk if you have a loss. As long as the sole proprietor is personally liable for all loans and obligations of the business and owns the assets used in the business, then all investment is at risk. For more information about material participation and at-risk rules, see Publication 925, Passive Activity and At-Risk Rules. If you pass the passive activity and at-risk rules, then it looks like your loss is almost deductible. The last item to verify is that your business is actually trying to make a profit and would not be considered a hobby activity. If your income and expenses are considered from a hobby activity, then the losses are not deductible and the income and expenses from the activity are not reported on Schedule C. Now, the IRS presumes an activity is for profit if there is net income from the activity in at least 3 of the last 5 years, including the current tax year. So realize if you had a loss for multiple years, this may be an IRS trigger to look at your business activity to verify that the losses are from a valid business. Some of the questions the IRS provides that they consider when analyzing an activity as a business or a hobby include the following on-screen questions. So to recap, if you have a loss but you materially participated in the business, you are at risk for everything invested in your business, and the activity is not considered a hobby, then your loss is qualified to be deducted. This means the net loss will be reported as a negative amount in the income section, offsetting all other types of income for total income. To put the loss situation into perspective, as an independent contractor, it would be rare to have a loss because contractors are most often providing services and usually must make more money than they spend to even be working. However, if you have other income and are able to spend more than you're earning, you obviously could end up in a loss situation, especially when you're investing and starting up your business. Also, investing in assets such as purchasing computers or equipment could create large depreciation expenses. Remember, aspects of depreciation can sometimes be a choice. So now that you understand the impacts of a gain or loss, you can plan your expenses and deductions to put you in the best situation for taxes. For example, if you know that you have a lot of income during the year, you may choose to plan for a loss and offset the loss from your work with your other income. Alternatively, you might choose not to use additional depreciation and save those depreciation expenses for future years. As a contractor, assuming you are the only person involved in funding your business work, you will most likely meet the criteria to deduct a loss.